Great. So why don't we get going? So for those in the audience, I'm Chris Feeney. I'm the Executive Vice President at the Bank Policy Institute. I wanted to thank the Federal Reserve of Philadelphia for having us here today. And we have quite a panel. We have an interesting panel because they really cover the landscape, everything from law firms to associations to firms that are actually investing in some of the firms that we've talked about earlier today. We are going to start with two presentations. One is from Phil Goldfelder. Thank you very much for filling in for Arlen. And then Brian King. So why don't I turn it over to you guys? We'll get moving with some presentations, and then we're going to do a little bit more of a Q&A with the panel and then with the audience, time permitting. So, great.
Thank you very, very much. It is a great pleasure to be here. Thank you all for coming back into the room. If you're following in your programs, I am not Arlen Gelbard. I am much better looking. Don't tell him I said that. So I'm here literally just for a couple of minutes because there is a big panel and a lot of folks who know a lot more than I do. I am a recovering politician, an aspiring banker, and excited to be here today to tell you that Cross River Bank is a New Jersey state-chartered FDIC insured bank. Full stop. Everything that you know about community banks, that is Cross River in terms of the regulations we have to follow, the rules that we have to follow, the way in which we have to carry ourselves. We have to carry ourselves as a community bank. And we're very proud of who we are. And so to give you a bit of our history, 10 years ago in 2008, as the financial world was collapsing, Cross River decided that was the right time to open a community bank. And the way I like to explain is that if you've all watched the movies where the building is essentially exploding and there's this one guy on a motorcycle that's just getting out of that big fireball that's exploding behind him, that's Cross River. We decided that in the crisis that we're going to step up and open a bank. And here was the best part. Because at that time, everybody was trying to reinvent themselves. They were trying to reimagine how they're going to handle themselves, whether they were the big banks or the small banks. Community banks that have been around for 100 years all now had to essentially change the way in which they were doing business. And Cross River was lucky in that we built our model around the new regulatory structure that was now in place. And so as part of our DNA was a regulatory compliance structure that we learned and were grown on and were born on. And so as we continue to grow as a community bank, we realized that, like most community banks, we've got to find new ways to reach customers and grow in our business. And so it started about 8 years ago, pretty early on in who we were. We partnered with a company called Green Sky to do point-of-sale loans at Home Depot. Now, this was an interesting idea, right, where we're going to originate loans that are outside of our area, outside of the area that we know, unsecured consumer debt to consumers who were being brought to us by somebody else. And so we learned really early on how to take these customers, take this business, and make it work within a regulatory structure that we are now under, ensuring everything that a community bank has to ensure. And so while, again, everybody is trying to reinterpret their business model, we were building ourselves in this new world of innovation and reaching new customers that others only dreamed of. And so we were really excited with this, but we continued to grow our capacity and to enable our regulatory compliance, our consumer protection as we continue to innovate. That evolved and evolved and evolved to today, where we are partnered with 14 marketplace lending platforms all across the country. In October, originating $800 million in unsecured consumer debt to, I believe, about 350,000 consumers, providing access to credit to people who otherwise wouldn't have that access. And we're proud of our partners. Partners like Marlette, you heard from Jeffrey Myler this morning, as partners like Upstart, like Rocket Loans, partners who we work with to ensure that we're providing access to credit in a way in which people are now accessing credit. But more importantly, and most importantly, it's who we are, ensuring regulatory compliance and consumer protection. And that is something that we were doing long before others, and we're very excited about our ability to grow and build a foundation in Fintech that is based on a compliance structure that people understand. Because we're not trying to reinvent the wheel, and we're not trying to create new regulatory structures for this new world of Fintech. What we're saying is that there's a system that's been around for 200 years. We're saying that as community banks, we're nimble enough, we're able to match our back end with the new innovation of the front end. And we're able to utilize these new technologies with these companies while still building our own technology on the back end. And so the more our companies in the fintech world innovates, the more we as a community bank innovate. And so as an example of that, there was a time where we were, like most, spot checking loans every 50 loans, 100 loans. We're re-underwriting these loans, and it was getting harder and harder as the volume was growing. And so we've built our own technology, and we brought in our own capacity to enable us to work with our platforms to re-underwrite and get a look at every single loan as it's made and do it in real time. And so this is just the beginning. Whether we evolve into payment space, into the cryptocurrency space, the idea is always to remain true to who we are as a community bank. And that's something that is in our DNA since we started and something that we take very, very seriously. We partner with those companies who we know hold the highest standards. And so as an example, Upstart was here before, talked very quickly about their no action letter. The no action letter is a good example of a company that says we want to be aggressively transparent. We want to tell you what we're doing and how we're doing it, what kind of data we're using and how we're using it to ensure that we are transparent, that we're following the regulatory structure that exists, and that we're always, always being mindful to the consumers and making sure that they're protected while always ensuring access to affordable, responsible credit.
Great. Thank you. Brian?
Thanks, Chris and Phil, and thanks for the opportunity to join the panel today. So my name is Brian King. I'm the first line of defense CRO, having joined Goldman Sachs earlier this year for the digital finance products, which most people know as Marcus. But I was asked to provide a brief introduction as to what Marcus is, because not everyone knows what Marcus is. So I have one slide I want to bring up, give you a little bit of the background. But effectively, there's multiple factors that led Goldman to start the Marcus business. Central, really at the heart of it, were a desire for customer centricity and the growth potential that we thought was possible. Not by gaining a large share of the market, but by gaining a reasonable share of a large market. So the leadership team effectively looked at the fact that we became a bank pretty much over a weekend in 2008. We were one of the few large financial institutions that was not doing traditional consumer banking. So we wanted to take a hard look at that a few years ago and see what the opportunity was. And arrived at the same conclusion that many of the fintechs here have arrived at, which is the large banks weren't necessarily delivering the customer centricity that we thought the market deserved and the customers deserved and demanded. And then if you take the background of Goldman, which is a very client-focused, client-centric historical business, is can we take the principles of Goldman and apply them to this type of business? And that's where the team arrived at the conclusion. So it was really, it was kind of a best of both worlds. It was, you have a big bank control, big bank risk DNA, 150-year-old bank risk DNA, and balance sheet. And then you have the opportunity without the legacy distribution channel and without the legacy tech debt, if you will, to do it right, to build it from scratch and to take advantage of that opportunity of building from the customer first in how we approach the business. So it was launched about 2.5 years ago, and just some of the quick stats are up on the screen today. So really 3 core lines of business right now, over 2 million customers in the last 2.5 years. The first would be the deposits business. We did acquire GE Deposit Platform back in 2016. We acquired it at about $9 billion in U.S. consumer deposits. We've grown that U.S. consumer deposits business to $27 billion today. We launched 6 weeks ago a deposit business in the UK. Phenomenal success with over $3 billion in U.S. dollars in less than 6 weeks of doing business in the UK, which really shows, the demand factor of not just storing money as a bank, but providing growth and interest as a bank to the customers, and how important that was, both in the U.S. and the UK marketplace. And then on the lending front, which many know us from, we do unsecured consumer loans, generally in the $3,500 to $40,000 range. Over the last 2 years, we've originated about $4 billion in those unsecured consumer loans. And then finally, we acquired a personal financial management fintech, Clarity Money. We acquired earlier this year. That came with 1 million customers who are using that personal financial management app to help provide more transparency in their financial lives, and I'll hopefully get into that a little bit more on the panel. So that was a brief introduction for those that didn't have the background on Marcus, and I'll turn it back over to Chris.
Great. Brian, thank you very much, and thank you, Phil, as well. So, Brian, I have a quick question for you before you can do it from there or over here. Okay. You came out of a traditional firm, and now you're in a firm that's actually reaching customers directly, and you're the chief risk officer.
Right.
So what do you think about differently as a digital company maybe versus a traditional company?
Yeah, I mean, I would say there was a couple, awakenings as I came into a company that was really just being a startup inside the big bank. One is I didn't have the 20 years legacy of data through the cycle, consumer data to model to on us type of data that I was used to having. But what I did have was incredible nimble technology that was, again, built from the ground up. So it enabled us the opportunity to acquire, smart data, not just from traditional data sources, but from alternate data sources to kind of answer and assess the full lending picture in the case of the lending business. And it was that way of thinking where, as the business was built, you have the marketing data, the digital interaction data, the finance data, the risk data, is being leveraged across the business, where appropriate, obviously, but across the business to make smart, very informed decisions. And because it was built, from the ground up, it all sits in one place, and it's a smart structure to be able to, be nimble in how we made decisions. So it was a big. Again, there's offsets. There's the concern of, wow, I just lost all my through the cycle data. I got to go acquire that from other sources. But the nimble technology, makes up for a lot of opportunity there. So.
Great, thank you. I'll let you walk across the stage now. Phil, I have a question for you as well. You guys, as Cross River, you provide platforms, you do compliance services, you deliver technology to these firms. It's the what keeps you up at night question, right? You're covering a lot of the landscape for a lot of these firms.
I think the question is better asked, what doesn't keep me up at night? The real answer is that we don't outsource any of our responsibility as a bank. It'd be easiest for us to say, well, it's not us, it's the platform's fault or problem or issue or concern. We don't do that. We give a hard look to the platforms we work with long before they're actually our partners. It starts from the analyst all the way up to our board, long before we ever partner with any of the fintech companies that we do. And then once we do, we assume full, complete responsibility for the regulatory compliance, consumer protections, for everything that you would expect from a community bank. And so, that's forever evolving. And our teams are growing. And as the innovation and the technology evolves, we have to stay on top of that and continue to ensure that we're doing everything right. But again, that just, I think, speaks to the level of partnership and trust and reliability that we have with our partners who know sort of what the restrictions, what the limitations are. But again, it's sort of an uncertain world, and every day things are changing, and we have to keep on top of that.
Great. So, Travis, I might turn to you, and for those on the panel who didn't stand up for a minute, feel free to introduce yourself and your firm, but I heard acquisition, build from scratch, technology, and your Citi Ventures, and you invest in these technologies. So how is the advent of better technology and the use of data to actually make credit decisions change the way you think about where you invest, who you invest, or even what you look for?
Yeah, so kind of answer that question as a part of the intro as well. So I think most people know Citibank, so I'm not going to do the commercial there, but I might take a minute on Citi Ventures. The name might imply that we're just the venture arm, the investing arm of the bank. That is one piece of what we do. But I think a comment was made earlier that there hasn't been really innovation in the bank since the ATM. I would argue that that might be true, and some we're not putting parts together and hardware and rolling them out anymore. I would agree with that. But I think there's been a lot of innovation inside the bank, and I think some of that might have been, the banks might have been complacent before 08, and then with the advent, I would argue that 08 really kicked off the beginning of all the fintech explosion that we're seeing now. And with that, I think the banks and financial services across the board has really had to wake up and change. And I don't think that's a surprise to anyone here, but I think why that's relevant to Citi Ventures is what we do as a whole is really help the bank be more innovative. And I know innovative is a word that we all toss around, and it's a really hard thing to do in a large organization, but Citi Ventures is one attempt at that. So we invest We also curate and build startups within the bank. We have more than 1,000 employees that have gone through a kind of agile training, startup mentality, and have launched more than 200 startups. A few of those are in very close stages to being launched as standalone businesses separate from Citi. We also have an R&D group that's touching and playing with things like with edge computing or quantum computing, next-gen distributed ledger technologies, all these things that the bank one day could roll out as, potential new technologies, or at least have some know-how within the bank. And the last group that we have is a group we call Studios. So working with our corporate peers to create and build things that might be like the next ATM, right? So we're building or thinking about how we build smart cities, how we re-educate the workforce in an ever-changing environment. So I think there's a lot going on within the bank, and this is just one group. There's many different groups within Citi that I think are focused on innovation. As it relates to Citi Ventures and where we invest, I think that question about how it's been evolving with the use of data, I think the expectation now is that all of our startups that we look at are leveraging data and maximizing that across the board. So if that's acquiring customers, underwriting customers, having better customer service, the expectation is that they're leveraging data to the fullest in a compliant way. So when GDPR hit, when the Cambridge Analytica stuff hit, it constantly throws a wrench in how these companies are coming to market. But it's super important to us as a bank that's got bigger problems than making really great investments in startups. The headline risk of being associated with a company that's misusing data is not worth it. So we take extra scrutiny on scrubbing the use of that data, but we expect and almost mandate that they're using it to their fullest.
Great, thank you. Fred, maybe I'll turn to you for a second, give you a chance to talk about PayJoy, but also you are really reaching the client that we talked about all morning, right? The client who is looking for credit, looking to make a purchase of some sort. You want to apply basically data to that, so it'd be great to hear.
I can just kind of do probably the brief overview. So about 5 months ago, I left my role as the Chief Risk Officer and Head of Data Science at Prosper Marketplace to join a young startup called PayJoy. We are currently active in 12 emerging markets around the world, and we have a patented locking technology that effectively collateralizes a smartphone. So for most of the folks we deal with, they're in Africa, Latin America, Southeast Asia. It's their first financial services transaction, and for many, it's their first access to a smartphone instead of a flip phone. So, M-Pesa, it's incredible how much has been able to be done on sort of a traditional SMS network, but moving from a SMS network kind of flip phone to a smartphone unlocks an incredible amount of opportunity. And really what I had joined for is sort of the second element of what we're doing. So one is enabling access to smartphones on a pay-go basis via the lock, but we have also built in a couple countries and are starting to build in a few others a data platform using SMS logs and user permissioned information so that you can really see how truly unbanked folks all over the world perform on their first or second financial services transaction, and take that information and enable financial services companies in those markets to start seeing that performance and having an assessment of the risk of the consumers. And eventually our hypothesis is that that data will be incredibly valuable and bring a lot of this sort of rising next billion onto more traditional financial services, albeit in sort of a non-traditional way.
Yeah, you sort of have a pay-as-you-go model, right? So it's a different model than we have here in the U.S. Do you see any overlap, and do you see any opportunity for people here in the U.S. who aren't as able to buy phones, use those services, to adopt a model like this? Is there room in this market for that model?
I think so. I hope so. I've talked with a couple of folks here today. The biggest opportunity I see is for small dollar short-term lending. It seems to me like the ability to collateralize a phone would be an incredibly natural fit to both increase inclusion and to bring down prices. So if someone's willing to collateralize a device, it seems like you should be willing to either say yes where you would have said no, or charge a lower interest rate, both through decreased operational costs as well as just general decreased risk. So, we haven't focused as much on the U.S., but if anybody out there would like to talk to me at the cocktail hour, we're certainly open to it. We have a
taking orders
full API. Yeah, so.
Take orders at the cocktail hour for anyone who's interested. So, Nat, I have a question for you because you represent a lot of the lenders, and it's a part of the market that's emerging. The data that's being used is making credit decisions more accurate, I would say. But there's a lot of policy that's not developed. There's regulation in place, whether it be state or federal based. What are you seeing, and what are your member firms looking for, and what are they asking for?
Sure. I'd say that everyone heard this morning the promise, I think, of additional data and the use of AI in both credit underwriting and fraud prevention. A lot of my member companies, again, beginning with just 3, Lending Club, Prosper, and Funding Circle, 2.5 years ago, and now we have 25 member companies and growing. And the whole idea of this association is really to first dispel some myths. So one of the myths is this is an unregulated space. Obviously, all the consumer lending law that applies broadly applies to my members. Many of my members that make up that 36% of all U.S. personal loans that we now account for are doing so through a bank partner model, which means that you have on the front end a regulated originating bank that's responsible, as Phil mentioned, for all aspects of the lending program. And then you have the need to set standards. So why do you have an association in Washington? It's really to kind of come together to define yourself. And so we've defined marketplace lending as being 36% APR and below. Usually in installment lending products that are simpler. I think the promise of this whole industry is to bring capital markets liquidity. So if you think about globally liquidity, there's more liquidity outside of the banking system than in, but bring that, often to support a really simple product, which is just an installment loan that goes to a consumer who's looking to borrow money and pay it back, without a lot of bells and whistles. And so that's really the promise of the association. In the small business area, we've also worked to set standards around, very small borrowers who often, I would argue, are using a commercial credit product and comparing it to a consumer product. So they might be looking at a personal loan, they might be looking at using their personal credit card, they might be looking at some sort of a commercial product. And so we've advocated for some sort of an annualized rates disclosure so that a small business borrower can really try to assess and compare the cost of the products, and they don't end up in a sort of a cycle of borrowing 3 or 4 very, very high APR products without at least assessing their alternatives.
Yeah, we heard some of that this morning as well. And Scott, maybe I'll turn to you for a minute. You have, Scott's with Ballard and Spahr, which is a law practice, but he also represents a lot of, sort of brand name companies. But you advise them on the way inbound, but you also represent them if there are any difficulties along the way. So it'd be interesting to know what you're seeing, what some of the expert advice you're applying, if you will, now to these firms, and what are you telling firms as they get into this end of the consumer market?
Well, first, let me say thank you for having me here today. I think we have a bit of a unique perspective in that we have a very large consumer finance practice at my firm, and we represent really all the asset classes that are out there. We represent the big national banks and regional banks and big credit card companies, student lenders, the sort of prime companies. And then imagine going all the way through the credit spectrum to the bottom, to payday lenders, high cost installment lenders, debt collectors, that kind of stuff, and everything in between. So the one observation that I would make is that earlier there were quite a lot of statements made about fintech companies, and I just don't think that it's appropriate to kind of combine everybody together that way, because depending on what your business is and who you're serving, the issues for small business finance are completely different than consumer, and the issues for consumer lenders who are basically doing debt consolidation loans for prime, super prime customers who have a lot of credit card debt versus someone who's a company that's focused more on the bottom end of the spectrum. I think those issues are completely different. So maybe I'll stop there and follow up later.
I couldn't agree more. I think that's one of the challenges that you see as people try to kind of unpack this space and study it. There are a lot of academic researchers in the audience, and that the need to kind of look at the different products and that are available on the web, and to kind of tease out what's for instance in our association, the average APR is under 15%. It's often a bank originated product. That's pretty different from a storefront installment loan where everybody who walks into that store is getting a 30 or 36% offer, and yet sometimes those products get mushed together because they're both installment loans. So I think that there's a lot of technology and decision science that's being used by some of the newer platforms that others just simply aren't using, and so it really behooves everyone to kind of try to dig in and understand it better as we sort of move forward.
So Chris, do you want me to answer your question with respect to alternative data?
That would be great.
Okay. Look, when we talk about alternative data, you're basically talking about anything other than a traditional credit report from the big three or a FICO score. And I think what we are seeing is, first of all, it is not true that only fintechs are using alternative data. I mean, we represent lots of big, giant national banks who are also using alternative data. Now, they're not using the sort of crazy things that people talk about, like digital footprints and social media behavior. There are all these, kind of bugaboos that are brought up at any time you're talking about alternative data. But they are looking at other data sources that are financial in nature. Have you paid your utility bill? That sort of thing, some of the other things that were talked about earlier today. But what they're doing is they are, almost all of them, or what we're recommending to them anyway, and I think what they're doing is they'll have a two-track process where, regulators don't want anybody to be cut out because they're adding these alternative data sources. So they'll underwrite them the old-fashioned way first, and then if they don't qualify the old-fashioned way, then they'll have a second run using some of the alternative data to see if they can qualify additional people. And so I think this is something that's much more widespread than just fintech companies. With respect to fintech companies, we're not seeing the incredibly broad spectrum of alternative data that people talk about in the research. I mean, we're primarily seeing companies use, maybe one exception is, where did you go to college, that sort of thing. I mean, everybody knows about SoFi, for example. But I would say that a lot of these companies are still using kind of traditional underwriting methods supplemented with some alternative data to try to qualify some additional people. And what we need to do when we are looking at their underwriting is you have to look at everything that's inside the black box. You have to figure out, is there anything, the way fair lending works, for anyone who's not familiar with it, there's basically two issues. There's disparate treatment, which means that I am kind of expressly discriminating against a protected class, or there is disparate impact, which means I'm not intentionally doing it, but I'm doing something else that has that effect down the road. And so the primary thing that we're really looking for, because we don't really see disparate treatment much at all. I've never seen it. Maybe some of my partners have seen something here and there, but I really don't think there's a whole lot of that out there these days anymore, at least not for our clients. But what you're looking for are proxies, because there are a lot of factors that correlate to protected classes. So for example, if you're looking at someone's job status and the fact that they are retired, that correlates with age. So that's something that is potentially problematic. So what you need to do with respect to anything like that is you need to ask yourself, well, is this really predictive? In other words, is there a permissible business purpose for using that data point? And if so, is there some alternative that can achieve the same result without using something that potentially has fair lending implications?
Great, thanks for that. So Phil and Brian, I'm going to ask, that was an interesting way to represent it, right? It's some of the data is being used, but it's not going as deep down into use of alternative data. There are still some traditional methods, but you both sort of look at that every day. What are you seeing, or would you agree with that statement? And
yeah, I would agree. Yeah. So I think sound lending principles are still based in the fundamentals, if you will, and the alternative data is being leveraged to go beyond to opt people in that otherwise wouldn't traditionally be opted in, and that's effectively what I see. It might get the usage of the data might be a little bit broader in other categories other than underwriting, like targeting or fraud purposes and things like that. But generally speaking, from an underwriting, it's sticking to the how do we get more people to qualify where we're getting false or no signals from the traditional credit bureaus.
Mm-hmm. Great, thank you. Yeah.
I guess I have a question on this, and maybe I have more liberty to talk about it since pretty much all of our business is outside of the U.S. now anyways. Does anybody else see it? I mean, I think in the room is kind of like a shame that everybody says that there's this TwoTrack process. So instead of taking as much information that someone will permit you to have as possible to qualify them for the best possible price, the largest loan amount, and the best possible product, that you have to do it as a second pass, and that's become the generally accepted way because of like a general kind of fear of regulators. That strikes me as a very kind of suboptimal outcome, I guess. Or I mean, I would argue that there are a lot of people that policy is harming, who qualify under traditional means, but are paying a higher price than they would if you were allowed to also use information like utility bill repayment in order to determine potentially a lower price for them. I don't know. I guess it just bothers me that we've kind of stuck at that being the accepted practice when it seems like it's harming so many potentially.
Yeah, I mean, our country just has a sorry history with redlining, so it's a hard conversation to start with. Fair lending, being something that everybody needs to follow and be careful about. At the same time, I think that's why there is a no action letter process at the CFPB. I think that's why regulators like Chair McWilliams are launching innovation offices. There's just a need to kind of unpack these issues and figure out what opportunities are being left on the table, how many people are being denied credit or being overcharged because of a lack of innovation in the regulatory community or a lack of, opportunity to try to use additional variables and find that sweet spot and find people the best possible product. I will say that the advantage of being a partner to a regulated institution is to at least pursue to a degree the permissionless innovation, to try to experiment on the boundary compared to being directly inside of an institution. So I think there's a natural, as we were talking about this morning, chocolate and peanut butter, there's a natural partnership between regulated institutions and fintech platforms in this area. It just has to be managed so carefully, and everyone is going to be wanting to be on the side of careful rather than on the side of aggressive until there's a little bit more clarity. And again, we have a fractured regulatory system, so it has to be clarity across the CFPB, the FDIC, the OCC, the Fed. This is not something that one regulator can wave a magic wand at and allow everyone to experiment with bringing people better credit.
So we like to, and again, what Nat said is exactly right, and I always love to talk about this, especially in a room like this where there's academics and different companies, is that we all have a responsibility to sort of be active, right? And I think you see some of the companies here, even members of NATS that are here, because they take a personal responsibility to be on the Hill, be in various states, sort of talk about what they're doing and how they're doing, and how they're doing it. And I give a tremendous amount of credit to those companies that go the extra mile to engage. We, as a bank, again, as sort of act as sort of, we like to think as our own personal sort of fintech sandbox, and that if they can ultimately work with Cross River, it means that they are in regulatory compliance. And so we have acted as sort of that barrier to only work and enable companies that are acting responsibly, regulatory compliant, ensuring consumer protection. But we all sort of talk about different technologies and great presentations today, but we've got to continue to do that in Washington and in every state across the country.
Yeah, I think, I'm sure there are people from the CFPB in the room who won't like this, but I think that there was a lot that happened under Director Cordray that really discouraged innovation. You talk about no action letters. There was one no action letter in the entire history of the CFPB, and it was not a traditional no action letter that you could actually rely on. There are more disclaimers in the letter than things that it permits. Going back to having traditional no action letters, going back to having traditional guidance so that industry understands what the rules are and so that they can raise questions ahead of time and get some regulatory guidance ahead of time as opposed to just being a target all of the time is what will foster innovation. And we need more of that. And there have been some very favorable changes going in that direction. The CFPB is I think, going to do much more with than Project Catalyst, which never really catalyzed anything in my experience. And if you look at the sandbox in Arizona, the AG, Paul Watkins, who put that program together in Arizona, is now at the CFPB running their sandbox program, and that's the sort of thing that's going to change facts on the ground. At some point, we probably should talk about fraud and marketing and fair lending as well, because there's lots of alternative data being used in those areas. You want to do that now?
Scott, you can come work with me if you need to, man. That's awesome.
So there are two areas that are that I think many people don't associate with underwriting and therefore don't associate with fair lending, and those are fraud screening and marketing. Everyone should be aware that the examination manual for fair lending put out by the FFIEC has a bunch of marketing questions that the regulators are going to look at for supervised institutions. But there's all kinds of crazy stuff going on out there in the marketing world right now. When you target ads on Facebook, for example, you can do all kinds of targeting based on protected classes. You can say, I only want to advertise to women of a certain age group, or people who have visited Spanish language websites and that sort of thing. And when you start doing that kind of thing, there's very little case law in the area. It's very questionable as to whether the fair lending laws apply to marketing, but as I indicated, the examination manual takes the position that it does. The only thing I'm aware of out there that provides any kind of guidance on this is the state of Washington. Their AG entered into an assurance of discontinuance, which is like a consent order with Facebook. I think it was in June of this year, because they were permitting their ads to be screened by ethnicity, I think, or race, where you could say, I'm not gonna, I only want this ad to be shown to certain people. Now, I'm not sure Facebook had any discriminatory intent there. I think actually there are some products that might appeal to, certain groups. But that being said, it is discrimination, and the question is it permissible discrimination or not? And in the marketing area, I think there are a lot of very challenging questions for companies to deal with in terms of figuring out, what do we want to do and what don't we want to do. I think it's easier for a very large institution with a very well-established brand that does lots of different kinds of marketing to get away with doing that kind of stuff, as opposed to a little fintech company that's advertising through a single channel and they're using protected class proxies or whatever to target their advertising, because, there are arguments that those are fair lending violations. And then with fraud, look, I'll tell you, we've seen all kinds of algorithms that look for users who have been visiting Russian language websites in certain areas in Los Angeles, because there are fraud rings operating from those places. But, zip code is one of these things that you just don't go there, even though it's defensible in a lot of ways. You can't target based on zip code in underwriting. It's just a giant mistake to do that. I think, we saw earlier today pictures of graffiti. I think that probably is a proxy for zip code in some respects. And so anyway, think about going through security at TSA, if they're doing racial profiling there, why is a fraud screen that only applies to people who speak Russian or who came from Russia, why doesn't that discriminate against the people who aren't part of those fraud rings? I mean, these are difficult questions. There's clearly a business justification, but it's also clearly discrimination, and these are tough issues to be dealt with. I'm talking too much. I'm going to stop.
I mean, I'd only just say that I think that what I've heard more, I think the former example would ring tons of alarm bells on disparate treatments. I don't actually think that in the marketing area, platforms are really getting themselves anywhere near a red line there. I think in the fraud prevention area, that's where, you can use things like geolocation. If somebody's applying with an IP address, they're saying they're in, Kansas and they're really in, the Ukraine, you might have questions about whether or not they're really, who they say they are. And so I think there's more there that is being done to just prevent, root out fraud using, again, data science and the information that is available out there on the web. I think one of the things that we've been pushing is for this bill that I think may get across the finish line this Congress, which is to have the IRS build an API on the 4506T form, which is the summary of your last year's tax return. So if you're trying to verify a piece of information, it's pretty critical. It's, what was that person's income? And if you could verify that, with their permission, their income using IRS data, that's a pretty hard source of data that right now is obviously not available in real time, even when people want to permission it. That it goes through, I think, still some fax machines and is sent by a horse and buggy. And so there are just little steps like that I think where resources that are available at the government, or the government taking a look at some things that are being done in the fraud space in one of these sandboxes or innovation offices would give everyone even more comfort, than they have currently to start to use them.
Great. So Travis, I'm going to ask you one more question, and then maybe we'll turn to the audience. We have a few minutes left, but how do you invest in this environment? I mean, there's just so many aspects of a firm you need to look at when you're thinking about alternative data and the different Fair Credit Reporting Act and so on and so forth. It'd be interesting to know what you've changed or how you model that.
No, and I didn't comment on this stuff because I think we're much more on the conservative side of it, right? So it's not worth it to throw in the next alternative data set or find the newest customer. I mean, we skew conservative because we have to and we need to. But when we look at companies to invest in, I'll talk just about the data companies, the alternative lending companies, but I think we think about it on three legs of a stool, right? So access to capital, which I think, starts in the traditional path that everyone's familiar with. You use your equity dollars, then your family and friends that, can do some debt, and then it's the angel, and then it's the traditional channels into syndication, which I think everyone's figured out now, and if you're any good, you can get to that access of capital. Second, we look at your ability to underwrite. There's broad ranges of your models and your data that you use, but I think generally we can kind of, at least where we participate in the investments, we can confirm that your ability to underwrite loans are falling within kind of normal standards. And then the last piece, which I think is what we just hit on, which is what we find most innovative and interesting and how we're trying to push the bank, is the ability to acquire customers cheaply, right? So we have access to capital. We have the ability to underwrite. So how do we continue to create customer experiences that keep customers? How do we target those customers? How do we do all that in the ways that a lot of the latest and greatest fintechs are coming out with? And I think if they're doing it in a compliant way, they're doing it in a way that will help us and gain some insights that we can help them as well, we're happy to invest in. But I would definitely say it's hard, right? So there's plenty of great companies out there that had to sit on the sidelines before going public because of, public market guys like, that we know who they are weren't succeeding, right? So I think those good companies will have a chance to go public sooner, and then the next wave can come up. So I think it's definitely hard, but those are some of the things we look at.
Great. Thank you. So I'm going to turn to the audience for a little bit and see if there are any questions. I think we have some folks with some mics in their hands, hopefully. So any questions from the audience? We have more than a few minutes left, probably 5 to 10. It's the end of there we go. There's one in the back. If you could let us know who you are and where you're from, that would be great.
Sure. Max Roy from the OCC. It's the first time that I hear about the model of using alternative data in a second pass model, and it's been sort of presented, framed as this is something that will lift people up without declining anyone. But if I come at it with the prior that a bank is going to maintain a constant volume, then it's easy to see a bank increasing its cutoff on its first pass model, anticipating it's going to lift people via a second pass. So I feel like this is a bit of a feel-good framing that I'm not sure that I'm fully buying. So maybe you do want to comment on this?
I think that there are other regulators who have expressed concerns that switching to an alternative model and only doing that may result in some people who previously would have been approved getting declined. And so the two-step process, you know, the regular model and then the expansion model or whatever the institution calls it, is designed to be a one-way ratchet where maybe you add, you're going to run the declines through the second model, and if they pass that, then they're going to be approved, and you're not going to miss anybody who would have been approved under the first model.
I don't really have anything. Jeffrey, do you?
Just seems shorter. I've heard of Marcus before. I had a question. Marcus has been in the news recently that as they look at 2019, originations are going to slow down. And I wondered to what extent you could comment. There might be three reasons that were speculated in the press. It could be CECL concerns. There's been announcements from the likes of JPM that, hey, they're going to curtail credit card originations and some other products because of the CECL impacts. Is that a concern? Is it macro concerns from an economic standpoint, or is it micro?
Yeah.
Let me give you the mic, or you've got one.
I'm good. I got one. So I'm not going to comment on speculation, but effectively, you know, like any new, hopefully well-run business and risk management approach, we're constantly looking at the results that we get in a growing portfolio and adjusting to make sure that the forward flow loans are meeting the return and loss objectives that we want to do in the business. So it's a constant reassessment of the business, constant monitoring, and that helps drive our business plans. We're under no pressure to, you know, internally within the firm to hit any growth milestones. It's growth, the right growth in the marketplace that makes sense for the business, not hitting any number of objective, and that's the way we're going to set our goals.
And I'll only add to that I think that features why both models, you know, one kind of capital markets funded and one balance sheet funded, are both important, right? Because banks that are doing it all on balance sheet and retaining 100% of the credit risk are going to be subject to different set of parameters than, you know, those that are selling, you know, through marketplace lending platforms, either whole loans that, you know, may go to banks but also are going to non-bank capital providers. And all of that is ending up as more availability of credit to the consumer in this channel that they're really voting with their feet for. So people are not walking in to traditional bank branches asking for credit. They're going online, they're searching Google, and they're ending up on LendingTree and Credit Karma, and the capital markets providers that can serve that channel, you know, are just as important a model as the bank model that can serve that channel. And all of that is leading to this, you know, phenomenal growth that you've seen in the personal lending product that a lot of people, and especially millennials, seem to prefer compared to the revolving credit balance and carrying a credit card and only making their minimum payment.
Great, so thank you. So we're close to back on track. I wanted to thank the panel for preparation and also for your comments today. So join me in thanking the panel.